Thanks for joining us for another MyWealth webinar. My name is Jeff Hunter. I'm a senior portfolio manager with the Townsend, Samani, and Hunter Group at Canaccord Genuity. Also on the line are our lead senior investment advisors, Dave Townsend and Raheem Samani. For more information about our team, our process, and the MyWealth portfolios, please visit mywealthmanager.ca. Today we have Ben Fawcett. Ben joined CG as a VP and Portfolio Manager of Investment Advisory Solution. He plays a crucial role in our in-house equity portfolios. Just to highlight right now, his North American portfolio is ranked number one amongst his peers in the SMA platform, which is pretty incredible over the last 1 year. He comes to us with over 20 years of investment experience and has managed equity portfolios using both quantitative and fundamental strategies. Most recently, he led a team that achieved an over decade-long track record of outperformance in managing mandates of over $3 billion. So, Ben, thanks again for joining us. I really appreciate your time and your insights. Um, Anything else you'd like to just add about your background for the audience here?
Um, well, first off, Jeff, thanks, and Dave and Raheem, thanks for having me back again, and thanks for everyone for taking time from their lunch to listen in. As far as the background, I mean, the only other part I would add actually is sort of what brought me into this role. Is I actually started out as a quantitative analyst. That was back in the UK for an investment bank and then a hedge fund before coming to Canada, working with a large insurance company in Canada, building what models, quantitative models that we had in the UK and Europe and bringing those over to Canada and North America. And from that point, it sort of led on to running sort of multi-billion dollar funds, very concentrated funds that we did a lot of very in-depth fundamental analysis because you'd own 100+ million of each position. So you really have to know the company and the management and go into the weeds. So what it did provide me is sort of that quantitative background and then a very deep fundamental experience as well, which I brought together working with Kevin Vandermeer here on the CG team as far as how these funds are run. So I can get more into that later on in the presentation. But again, yeah, thank you for everyone for listening in. Just as far as the plan here, as far as what I wanted to get through. I'll probably speak for 10, 15 minutes. There's a couple of topics I think are particularly relevant right now. One is how to navigate volatile markets and a few tips I've learned over the years. A second is just to talk about the new Prime Minister, Carney. He named his cabinet today. And just want to talk about some of the opportunities on the economic side from Canada. I'm actually pretty positive about we've been through a few rough years. And I think there's a lot of low-hanging fruit, and I think there's actually some opportunity there. So I just want to give some thoughts on that. And then finally, talking about the US and administration right now, the tariff war that's going on, how I ultimately think this is going to play out because it does have so much impact on North American and global markets. So with that said, I'll just switch on to the next slide, please, Kate. And the fund we'll speak about that Jeff introduces, the North American Focus Fund. There's 5 different funds on the CG platform: a Canadian equity, Canadian dividend, a US equity, and the North American one, which bridges US and Canada. I can dig into this a bit further, but it's a great portfolio in the sense that it covers so much ground, from Canadian commodity companies, energy companies, a lot of the cyclical sort of side of the economy, as well as the Canadian financials, and you pairing that with big secular growers on the US side. So when I look at a really nice, broad, diversified, all-weather type portfolio, this is it. And you can see it in how it's performed and even how it performed over the last few months in some very volatile markets. It's a really steady performer from that standpoint. But anyway, I can talk about more about the strategy later. Maybe if we move on to slide 3, please, Kate. So the first area I wanted to touch on is just 3 sort of lessons that I've learned in, doing this 25+ years managing institutional money. So, I've been through 2000 tech bubble, 2008 great financial crisis, the COVID meltdown, and a ton of other markets in between then, when it actually felt like we were staring into the abyss to some extent. And there's a couple of sort of takeaways. One is you have to sort of tune out some of the noise, turn off the devices, turn off TV, don't stare at your screens all the time because it becomes all encompassing. You have to sort of look back and say, okay, what do I actually believe? What does the data say historically? And when you get into these situations, if the market is 15% off its highs, historically, if you've got a window of a year or longer, that's generally a very good time to buy. And if it's down 20%, then you really start buying. So when markets go down, the time you want to sell and you feel like you should be selling is actually the data will show you. And I've got 100 years of data. I've gone through this, plus all my experience. Those are the times you should be buying. We saw that recently. I don't know if we've seen the bottom yet. Certainly, there could be some more volatility coming up. But what I can say in those situations are markets go up 3/4 of years, have a positive return on markets. And when you get those opportunities, those 15 to 20% pullbacks, those are the opportunities to add any cash. At the same time, I wouldn't be trying to time market. So I wouldn't be trying to sell to sort of catch that opportunity. But when you do have cash on the sidelines, those are the times that you just put it in. And historically, we've seen you earn an outsized return from those. Moving on to slide 4, there's a couple more here. The second strategy is remember what you're buying. You're buying a business. And if you think about that, if you're buying a business, you're buying earnings, you're buying cash flow. And those cash flows are going to be coming, into perpetuity. And you're certainly paying for the next 10 or 20 years of those cash flows. So let's say we're going to go into a recession. It's going to be a rough year. Maybe next year is going to be rough too. Those earnings could be off 20, 30%, generally less than that, but they could be off. But think about the valuation of a business. Yes, the next year or two are going to have lower cash flows, but you're still going to have some cash flows. And then you're going to get year after that, and everything after that. So if you're discounting a company, in some cases, we've seen it recently by say 40%, does that actually make sense? And in most cases, it doesn't, which you'll see these very violent sell-offs. And if you're buying a good quality company, and I should caveat that, a proper company that has cash flows and has a balance sheet, you'll see a big move up fairly shortly after generally. And so always remember, this is a business, it's not a stock. And you can get too sort of focused on that fact. The final part strategy is, stick to your plan. This is why you work with Jeff, Dave, and Raheem to come up with a plan. The plan you sort of put together when things are quiet and everything's humming along nicely. And every now and again, you're going to hit these bumps. And that's when your plan kicks in. And that's when you just sit there and you say, we've set up for this, we planned for this, we knew this was going to happen. It will come back. It always has. And we're going to stick with that plan. And, the volatility is part of the game. Volatility is what gives you those outsized returns of investing in equities. And you do at times just have to say, we've set this up properly. It's well designed. We've got good balance in the portfolio, the right asset allocation, and just going to have to sort of sit through it and wait for the other side. So anyway, those are sort of 3 battle-tested strategies that I always use as a bit of a North Star when, it feels like the world's coming in a little bit because of CNBC and every headline you see is telling you that it's the end of the world. Okay, going to switch gears completely now. New Prime Minister, not quite a majority government. I think this is going to be a change from the last Liberal government. I mean, this is another Liberal government. So we've had 4 in a row now, which hasn't happened, I think, since the 60s, and 3 minority Liberal governments, 2 in a row. I won't go back into Carney's background because I'm sure everyone's very familiar with it, but you are dealing with someone that's an economist and obviously, head of the Bank of Canada, head of the Bank of England. If I'm looking at the Canadian economy, the way I say we've been bumping along the bottom for a few years. If you look at that chart on the right, you can actually see per capita growth, GDP growth, Canada, the blue line at the bottom that's sort of gone sideways for a decade, versus the US and EU, for all its problems over the last decade, it's actually done pretty well too. So Canada has been this huge underperformer. And if you look at the Canadian economy and highly educated workforce, very developed country, there's really isn't a sustainable or structural reason that can't change and we can't catch up. And I think that's the opportunity for Carney ahead of him. And I think he's someone that actually can help capture some of that. So that's where I have a fair bit of optimism as far as where Canada is and what the prospects for the next year or two are. You've also seen that a little bit with the Canadian dollar, which there were some expectations it was going to fall down to 65 cents, and it's actually stabilized above 70 cents and been performing pretty well. So I'll just touch on a couple of things. I'm probably going over time-wise already, but a few of the key areas. So one is obviously Trump and tariffs. And, I'll touch on this in the next slide too, but I think Carney has a decent relationship. I think the US actually needs Canada. There isn't a trade problem as far as Canada-US trading. Trade is balanced, it's fair. We already have negotiated free trade agreements. Maybe there's some small changes could be made to those, but overall, I actually don't think we're going to see any big changes from that front. Just for the fact that the US probably wants a few friendly neighbors that it can trade with, especially if it wants to focus on more important areas where there is significant issues such as China. And the second point there, I'd point out, if Europe and say Asia are trading less with the US, that actually creates a vacuum where Canadian manufactured products can actually go down to the US because they do have those free trade agreements, which I expect are going to continue. So I think Canada could actually incrementally benefit from this situation over time once we get a bit of clarity. And I think Carney and Trump will hash that out over the next couple of months. Interprovincial trade is a huge opportunity. It's been talked around and studied for decades. Interprovincial trade is actually 530 billion in 2024. So that's more than our trade with the US. IMF and other international organizations have sort of looked at all the ways we stop provinces from trading with each other. And, if you can sort of push everyone together, work through some of those, they're actually huge improvements as far as increased trade, lower costs. You can get 4+% GDP opportunity. I've seen numbers up to 8%. So this really is a big number we're dealing with. In Carney's cabinet announcement today, it sounds like Friedland's going to be actually heading up that area, but he's also said that by Canada Day, by Canada Day, he'll be removing federal restrictions and harmonizing federal regulations on a provincial basis. So that's a start. And then a lot of the premiers have also said they're going to start doing the same. So I think we finally have that crisis that's going to drive this. And I think that's a huge opportunity. Energy policy, obviously an area that really was ignored by the last government. Again, huge opportunities from an LNG standpoint on the West Coast. You've got the TransCanada's natural gas pipeline built. It's easy to add compression there. Billions of dollars investment potentially in new liquefaction terminals. You just need the regulation side to start moving ahead. And again, I think if you look at who Carney named as his new energy minister, ex-Goldman Sachs, head of Canada, and he's also been an advisor to Carney in the past. So it's obviously someone that he considers highly. They have a good working relationship and someone that can sort of handle this and get this across the line. So I think there's real potential, both on a nat gas LNG side, but also as far as an oil pipeline, be it Northern Gateway or an East Coast pipeline. So I think things are going to move there, and the approvals process is probably one of the key areas there, and no doubt some government funding. And then finally, there's a lot to say on this standpoint, but Carney will be spending, and that can be good and bad, obviously, because it doesn't improve the debt, but at the same time, if you spend wisely, Canada probably could use some investment in a number of areas. So if that is done wisely, that actually will be quite stimulative to the Canadian economy. So that's something else that's actually going to help the Canadian economy over the next few years. The tax aspect, income taxes have been announced. They will come down 1%. We'll see if more happens there. The big area, though, is corporate taxes. After Trump cut US corporate taxes in his first term, Canada was no longer aligned with US tax policy, and we need to get that. Otherwise, Canadian businesses will invest in the US, and you're not going to invest in Canada, you'll invest in the US because you pay less taxes. I think That's something that politically very difficult to bring up in Canada, but I have a feeling that discussion is going to start happening later this year when the US starts talking about extending Trump's tax cuts from his first term, as well as adding in further potential cuts. So I think that's going to be an important discussion that's going to happen in Canada later in this year. And finally, infrastructure, housing, and other areas, I think they will be spending, which again, positive for the Canadian economy in some ways. So overall, it paints a fairly constructive picture for Canada looking forward. I'm a lot more optimistic than I was, say, 12 months ago. Moving on to slide 6. And Jeff, I wanted to leave some time for the Q&A here, so I think I've gone a bit over. I just want to say, as far as Trump's realizing the realities, and I would argue he's overplayed his hand. US has a lot of power and influence, but it isn't complete. So if you want to tariff China, are you really going to try and tariff everyone? That becomes far more difficult. Do you want tax cuts? Do you want to extend your existing tax cuts? Do you want new tax cuts? Do you want to win the midterm election? If you have tariffs for everyone, you probably end up with a recession. If you have a recession, odds are the Republicans won't win the midterm elections. And that means Trump's probably going to spend the last 2 years of his term fighting impeachment charges from the Democrats. Probably not what he wants. So that's a real constraint that if you're Donald Trump right now, you're thinking, how do I want to pursue this? What was he elected for? What do US voters actually want? They wanted lower prices. They wanted lower taxes. They wanted economic growth. They didn't actually care about trade or tariffs. So when you sort of put all these real world constraints in place and start thinking about it, I think the tariff narrative is going to fade. We'll increasingly see the off-ramp being taken there, and that starts to de-escalate. So we're past peak uncertainty from a tariff standpoint. There will be a rug pull or something else that's going to happen. So it's not all done, but I think we're on the off-ramp now. I think tax cuts become a bigger focus, deregulation, DOGE and some of the spending cut aspects of the US, with Elon Musk, I think those are fading too because they found out that's too difficult. And the final aspect is Powell has been sort of sitting on his hands. Rates are over 4% in the US. That's too tight for where the economy is right now, but he's been worried about potential inflation with tariffs. As that narrative eases, I think you will actually get a couple of Fed cuts at the very least this year. So I think we've sort of gone through the rough part of the market. There's going to be more volatility over the next couple of months. But I think, we're moving up now and we can end the year at new highs ultimately. So with that said, Jeff, those are sort of the prepared comments I wanted to get through.
Well, thanks. Let's start with the North America portfolio. What's been driving the performance this year? How have you managed the volatility and how is it currently positioned?
Yeah, I mean, the first thing I'll say about the model is it's broadly diversified, so sectors and geographically between Canada and the US. So it's not designed to perform in a certain type of market. We use a quantitative model that is basically picking stocks, so individual stocks, and we're focused on those rather than saying we think the market's going to go up or go down, or interest rates are going to be here or there. The idea is to pick good stocks and let those stocks basically carry the portfolio over time. So as far as positioning, we will make tilts to some extent. So coming into the year, I actually underestimated the impact of the tariff discussions and how far that would get pushed. So things were looking good in January. We did hit some bumps in February, but then again, markets have come back pretty hard since Liberation Day at the start of April, and the portfolio has been performing well. I think it's up about 2% year to date. So despite all the noise, it's actually in positive territory. When we did hit that volatility, there was a focus on some higher quality names. So that's when I look at Canadian companies like Waste Connections, Intact Financial, decent quality names. Names I'm probably looking at now would be the ones that would be benefit if we sort of get a bit of a cyclical improvement in the Canadian economy, for example. So CP Rail is a name we added recently. I think that one hasn't done much for a couple of years, but I think great operation. It's got that east-west, north-south network. Once the tariff concerns abate and some of the economic concerns in Canada too, I think a great management team can do a lot there. So definitely looking at a few new opportunities from that standpoint.
So, what does a quantitative aspect of the process contribute? For those that don't understand what
Sure.
that means, can you just highlight specifically what that is? And you're this market's been very driven by emotion and headlines. So, how do you adjust using that lens given the current environment?
Sure. I'll say one thing, doing this for 25 years, and I've seen this other people who've done this the long term, you learn a lot about a lot of different things. You also start making assumptions. And the reality is situations change over time and people don't often change those assumptions with this. So where the quantitative process comes, it gives you discipline. Ultimately, what we're doing here is we're ranking companies by sort of key aspects. What's the quality of that company? Returns on invested capital? What's the valuation of that company look like? What's sentiment towards the company? What's growth? So we're looking at some of those standard characteristics of what I consider a good investment long term. And we're actually ranking companies. So we have a screening process. We backtest that screening process over 20 or 30 years to make sure we're looking at the right types of characteristics that have shown statistically to add performance over time. So that's where the sort of intellectual rigor comes into this process. So once we have that, we said, these are the factors you need to be looking at. I can show that by backtesting that data over time, or I can just show that by explaining this is why higher quality companies tend to outperform over time. We don't run those models every day. And that's a dashboard that I can look at, and it's scoring all our companies and saying, okay, this is a company here. Maybe it's time to start looking at this one. This is one here that's actually deteriorating. Something's changed. And it questions you. And it makes you ask, say, do I still believe in this? Or I may have a certain misconception about a company, and it will question that. I do the work and I say, okay, I need to change my view here. So the biggest thing I would say is it provides discipline and forces us to do what we, walk the talk effectively.
So, with the portfolio, we have US and Canada, two very different structural markets in terms of how they're designed from an index basis. How do you choose the companies and how do you balance within those two spaces?
Yeah. Part of what I like about the North American market from that standpoint is, if you look at diversification, it's risk return. By adding more different sort of geographical areas, you can lower the overall risk of a portfolio without impacting performance. So that's the idea here is Canada's a very different economy than, say, the US, just because Canada has the resource side. Its banks are very different than US banks, for example, just because they're far more conservatively run, they're very strong. So what you get from a Canadian portfolio is you managing some of those cyclical aspects, some of those commodity aspects. You've got gold. I mean, if you look at gold this year, it's been a huge performer. It's almost single-handedly held up the Canadian market. So you have all those elements that you can then combine with the US, where you have some amazing sort of secular growers. And it just provides a really wide, broad, diversified portfolio as far as different sectors. And again, what that tends to be happen is you have more offset. So when one group isn't working, something else is working. You just get a far more steady portfolio.
So, looking beyond just North America, how do international, dividend, or even just US or Canadian focused portfolios different in terms of style and positioning?
Yeah. The investment process is similar. I mean, if I'm looking at European or Japanese companies, for example, there's different factors I'll look at. They're broadly quality, value, and momentum, but there are different indicators that might work better in some markets just due to the composition of the sector breakdown of the types of companies in those regions. So the models we run are different, and again, they're back tested historically for the different geographic areas. Where I'd consider, say, if you want a one-stop sort of shopping, the North American portfolio is great. 50% roughly Canada, 50% US. Covers, like I said, a lot of ground in one fund. If you want to sort of fine tune some of your asset allocation, you could, change your US weighting. You can add in international, for example. So you might want, say, 40% US, 20% Canada, 30%, did I get my math wrong there? 50% US, 30% international to broaden out create a more diversified portfolio. So that's where those different funds can be useful and more in a mix and match approach. There's also a dividend focused portfolio on the Canadian side for investors that are looking for more dividend income.
So just in certain themes, we have WTI trading around $63 a barrel. How are you thinking about oil and gas exposure, and how is the portfolio positioned in the space?
Sure. I'll give you some parameters where I tend to think of the oil price generally. So a lot of US production comes from mature wells in the US. So they need about 65 US dollars. Otherwise, that's where the cash costs. Otherwise, they stop producing. So if oil goes below that for very long, you see US production actually start to come off. You have another scenario. If North America goes into recession, you're probably talking about $50 oil. Right now, we're slightly below that $65 area because the market is still saying there is a risk of recession if the tariff issue isn't sorted out. So that's where the market is right now. We're right down at the bottom of the range. The top of the range, you know, you're probably in your 80s. OPEC would like, Saudis would like $99 oil, but realistically 80 to 85 in a balanced market. The reason is you still have 2 million barrels of OPEC plus oil that they never brought back after COVID, and those are sitting on the market if the price gets high enough. So I sort of think of oil as trading between a 65 and 80, $85 range in a normal environment. So at these levels, I don't think North America is going to go into recession, so I think the oil price is too low. And you know, the way I'd put it is we're at the bottom of that range now. Nat gas, I'm also constructive on just because I think you're going to start getting LNG Canada this summer, and you've got a ton of LNG capacity coming on in the US over the next 3 years. And then subsequently, I'd hope you get more LNG West Coast Canada capacity coming on. So, you know, own names like Peyto to benefit from that. And also the final part from the equity standpoint, you know, we do own likes of IMO, CNQ, Suncor, Peyto, like I said, just because they do generate a lot of cash flow even at $60 oil, and they return that cash flow. The balance sheets are pristine, so that cash flow comes back to investors in buybacks and dividends. So the total cash yield on these stocks is very good still. So they're definitely part of the portfolio, and I like them down at these oil prices.
Perfect. Raheem?
Hey Ben, quick
Hey.
question on gold. You know, it's very topical, but
Yeah.
it's a hard metal, and it's a metal that's in demand. Got a lot of cross currents going on with you know, the Chinese and the Saudis per se, and you know, you got Trump going from show me the tariff to now show me the love. And you know, it was pretty interesting speech today, where you know he's going to drill down where he sees capital, and no other reason why he's in the Middle East than to drive capital. But you know, what's the prognosis on gold here? Where we hit all-time highs, you know, it's going to relax a bit. Um, you know, what are you guys seeing through your lens on your side?
Yeah, I think again, there've been a number of ways you can approach gold, and over the last 20 years, I've sort of gone down a number of avenues. I think the key one right now is de-dollarization, and the fact that there's a significant portion of the world that doesn't want to be solely based on US dollars as the reserve currency. What really kicked off this one would be the Ukraine war and the sanctions that were applied globally against Russia. So Russia stopped exporting its gold and was building up its reserves. You've seen the same with a number of Middle East countries. You can see China's central bank has been buying gold pretty consistently. They walk away occasionally after a big run, but they always come back. So that central bank buying is the key driver, and that need to diversify, or desire, I should add, to diversify away from US dollars. Short term, so with that said, you know, that's been a 5% position gold in the portfolio. So we've been there all along, and it's done very well for us. We've seen some significant moves recently that's sort of in this sort of risk-off environment. And we are seeing investors increasingly buy the ETF. So there's a speculative aspect that is starting to creep into the market. So I feel it's a bit overdone at this point. That said, if I look at Chinese reserves of gold, they're still very low, same with a lot of other emerging markets. And so I think those are going to continue to build. So I think there is a bid that is going to come back to that market, and I'm still constructive. I just think it's probably overdone a little bit in the short term.
I like that answer. And then, moving to more of the technology angle, AI, machine learning. Great opportunity here for, companies, sectors to enhance productivity, reduce costs. What are we thinking here on the AI play? What are you looking at? This is the number one question I get every day from investors, from, or some of our larger institutional or family office accounts. How do we get exposure to AI? How do we study AI? And what are some of the names that are going to have some endearing, repeatable revenue in AI and that are just not, one and done investments where they actually have a business model, not just a theory?
Yeah. Lots of ways to go on that one. AI is probably the one theme that, we've been through DeepSeek and supposedly the end of AI. It's probably the one area I'm by far the most excited as far, if we're looking on a multi-year basis, as far as the prospects. I look at how much I use it in my day, how much the team uses it when I talk to other people, be it lawyers, doctors, accounting. Increasingly it's becoming a bigger and bigger part of everyone's day. And there's huge productivity aspects that come from that. So anecdotally hearing a lot. What's the best way to invest in that? I think the chips at this stage, I'm less positive. I think they'll be fine to some extent, but I think it's moved on to some extent from that standpoint. You have more competition coming off. Yes, NVIDIA may or may not have the best chips forever, but I think there's better ways to play than the chip. You've got the electricity demand and some of the infrastructure, utilities type plays there. And those are good, but you got to keep in mind that even if electricity demand is increased by 2-3% a year globally, I mean, that's a massive number. I don't even know if you can actually build it out. Building out electricity generation is very time consuming, requires huge amounts of capital. So those investments are fine, but you can't really leverage them either to some extent. So where I'm increasingly looking is who's actually making money from AI today. And the bigger, more interesting one is, where is it going to be 2 years from now? And that's the bit that gets me really excited. So people like today, right now, Meta and Instagram, they're not using it to put anyone on the moon or solve cancer or anything. They're using AI to study your habits and what engages you and make you sit on that device and feed you ads. And they're doing it very well, and you're seeing it in their results. 3.5 billion people sign on to one of their applications every day. Which is scary in many ways, but they're definitely capitalizing on it. AppLovin is another advertising company that's doing very well. I think companies like Shopify, even GoDaddy, which we own in the portfolio, we own both of those. Short term, they're definitely in a position where advertising seems to be one of the immediate areas benefiting from AI. I think the next stage is, and this is where I'm hearing more anecdotal, is if I look at cat manufacturing, heavy equipment, big trucks and haulers, and they're full of sensors, and increasingly they're using AI to monitor those sensors, identify problems early, schedule maintenance, and also organize the maintenance side. So you can just this huge optimization, monitoring and optimization process. And you're talking efficiencies in the 10, 20, 30%. In some cases. Again, this is anecdotal and I haven't sort of seen it really flow down, but it just shows the huge opportunity for optimization throughout the economy. If I'm looking at healthcare companies, insurance companies, how they actually price policies, their models are pretty crude actually, and there's so much they could do with this. And then it's also how you manage the client too. There's just so many ways you can go. So that's where I'm increasingly, looking at some of those, say, insurance companies and the benefits they could derive. And I think there's going to be more and more of that. And I'll probably be talking about that more over the next year, because that gets me super excited. That's what gets us to new highs in the market. And pretty optimistic from that standpoint.
One last question for you, putting the political lens back on. Trump plays a pretty interesting game, right? Doesn't want Canada's water, but he needs it. Doesn't want
Yeah.
Canada's energy, but he needs it.
Yeah.
Doesn't want Canada's, resources and minerals, but he needs it. Doesn't want Canada's intellectual capital, but he'll take it.
Yeah.
So what's the ask now for, from your end, a lot of American companies come into Canada and fail and leave, right? So I don't know if it's market access that he wants. Maybe he wants access to the financial sector. But, from your, looking at companies, studying sectors, looking at the US Canadian sort of investment field, there is an ask
Hmm.
by Trump. What do you think that number one ask is? What does he really want? He knows he can't have a lot,
Yeah.
but what can Carney give him?
Yeah. I mean, to your point, he knows he can't. I think he didn't know he couldn't have a lot at one point. I think that's that natural constraint framework where he's realized, okay, what do you actually want now? Because you can't have it all. I do think actually one, I think the NAFTA or the negotiations didn't go well in his first term. He didn't get what he wants. So there's a few small things from that standpoint. I would actually put security, I think, is one of the big areas that we can actually give him something. Not so much border security on the south, but northern security too. I think increasingly that's a bigger and bigger concern to him. And I think that's an area Canada does need to invest. And that's something we can hand him that, you've seen with Greenland. Why does he really care that much about Greenland? Partly the resource, but I think it's more of a security issue. You've got Russia, you've got China, you've got others increasingly encroaching from that standpoint. So I think that's one area where we probably will be able to reassure him to something and give him a win. I think a lot of the other areas are fairly minor to some extent, and he'll sort of get more of a token reply.
That's all for me, Jeff.
Sorry, switching to the Canadian consumer, we have a large number of mortgage retests on the horizon in the second half of the year, and we have higher interest in focus. Thoughts on there? What's your take?
Yeah. I mean, this is a problem that we've obviously known about for 5 years that it was going to come. So it's definitely, I would say, it's priced in the market. Well, the market knows about the market prices about it. And it's definitely been out there for a long time. A couple of other observations. One is interest rates don't translate directly into mortgage payments. When interest rates are lower, the mortgage payments are higher, you just pay down your principal at a faster rate. So just because interest rates might be people that had a 2% rate may be resetting this year at say 4%, their mortgage payments aren't going to be doubling. They'll just be paying down less for the principal, which isn't great, but it also means that the financial hit isn't as significant as it might seem on the surface. It's still material though. Bank of Canada has done a lot of work looking at this because obviously, it ties in nicely with their rate setting policy. And their studies indicate that, the people that are most impacted, the homeowners, tend to still be employed. And if they're employed, wage growth has been good in Canada. And you've had some significant inflation and wage inflation over the last 5 years too, that can offset a lot of those increased mortgage payments. So I think it's definitely an issue, but I think between the lower rates we have now, the Bank of Canada can lower more. I think the federal government's going to be spending a lot of money too, like I said. I think the consumer can get through this in Canada. The balance sheet still is not as pristine as, say, US consumers is unfortunately, that's the one sort of fly in the ointment.
So Canadians have had a lot to digest, and Canadian investors. I think this has come up a lot in conversations that I would almost say it's almost been not market oriented. It's been more of a mental fatigue over the last 5 years. COVID, two wars, the inflation bout in 2022, where we're now just getting used to those prices, which
Yep.
are still, in my mind, pretty insane
Yep.
from a historic precedence. And then Trump was kind of the final, the straw that broke a lot of people, the camel's back in a lot of
Yeah.
instances. And there's been a lot of negativity. There's been a lot of optimism on it. We've seen in other side from developments in technologies and healthcares and other facets, but what are some of the positive stories or trends that you're seeing in what has been, I don't want to call it dark days, but it's been mentally exhausting for a lot of people, where they've actually been affected by it, as opposed to just reading it on the newsline and debating it over at Timmy's.
I agree. I mean, it was interesting. I mean, just talking to friends, family, clients, there was something very tangible in the fear and the sort of pain, when especially the tariff issue came up, because, like you said, Canadians have been through a lot in the last few years. Um, and I always like to think, this is probably the darkest hour before the dawn type thing. So, as far as the positives coming ahead, we have a prime minister now, which we didn't for a while. So we're dealing with Trump and really no one running the show to some extent. I think Trump is going to have to, and he's been one part of that. So like I said, he's going to have to start focusing in areas that are good for the US economy, and ultimately what's good for the US economy is good for Canadian economy. So that's moving in a direction that's better. I think the tariff side of things dies down. I think Canada actually will benefit from some of the trade wars that will be ongoing with, say, China, and potentially even Europe. We are that landing pad that you can access the US economy. So I think that's positive. And then I think there's a lot of economic policy in Canada that is finally, like I said, we've lagged so much. So we don't even have to do anything particularly clever or special. We just have to sort of, is the block and tackle side of things, and right from there we'll actually start to really feel an improvement from that standpoint. And we've got Bank of Canada's at 2 3/4 right now, so rates are relatively low. They'll probably come down a couple more points. And overall, Canada's a huge country with a ton of resources, and maybe we'll actually start taking advantage of that a little bit more. So there's actually I haven't felt this positive about Canada in a while. So yeah, I think it's a
That's
good
awesome.
story.
Just one more question from the audience in there. You talked about the weakness in the US dollar from other people's views and on gold in particular. There's also been a little bit more exposure to those that have restrictions on purchasing it through stable coins and cryptocurrencies, where you can get exposure to the US dollar without physically owning it if you cannot. How do you see this on the longer term trend, but also with the FX on the global currencies? How will it affect corporate and government bonds,
Um,
especially globally? I know we're talking on the equity side, but I might as well slide that one in.
yeah. So you're talking the impact of stable coins, or just a sort of a decline in the
No,
US
more
dollar
so
standpoint?
the FX movements,
Yeah,
and then global debt.
yeah. Okay. I think there's a bunch of different factors there. From an FX standpoint, US dollar probably has seen its highs. One aspect, what we've seen here, and I think this is actually part of a positive story, is, you know, other regions of the world are increasingly going to stand up for themselves. So that's partly through defense spending, infrastructure spending, and Europe is one of those areas. I think there's different pockets in Asia too that will also do the same. So globally, you're actually going to have regional powers and they will trade. And that generally actually raises the bar for everyone. Part of that will be there's increased spending. The US drove a lot of its economic growth over the last decade, say upwards of half of it, arguably, through fiscal spending, just raising debt. They can't do that anymore to some extent. Rest of the world is in much better shape, so they can. So I think you'll see a lot more debt spending globally, actually, and better economic growth. Um, what does that do for the US dollar? I think that pressures the US dollar going forward. So I think that's good for the CAD. I think that's good for the euro going forward. I think from an investment standpoint on equities, you have to look at those US equities. Do they generate their earnings in the US, or would it be like, say, a Google, which earns 50% of it global? And there's a whole bunch of FX considerations from that standpoint. From a rate standpoint and US dollar, I think this is partly why we've seen rates go up here. I don't want to get into discussions of the term premium, but I think investors are increasingly concerned about the amount of the debt the US has and what that means for the long-term prospects. So if you're looking at a 10-year yield and bond, what's the US going to look like in 10 years from a budget standpoint? And investors are increasingly asking for more return on the back end to hold US debt longer term. And that's a concern. So that probably means from a US standpoint, you might have higher rates. I don't think 5% is out of the question. Not right now, but as investors start asking for more, that is definitely a concern longer term.
Awesome. Well, thank you everyone who joined us on your lunch hour. Thanks, Ben. Really appreciate your insights and also your performance, which has been pretty stellar. So thank you for keeping the line open. And for those that are on the recording, or sorry, that were on the call, you'll get the recording in the next couple of days. Any questions, reach out to Dave, Raheem, or myself. Happy to talk further. Have a great day.
Great talking again. Thanks very much, everyone.
Thanks.
Yes.